I am Emma Reporter, and you're watching CA Reporter. Tonight, we need to talk about what's happening in our own backyard. The Vancouver housing market has plunged to activity levels we haven't seen in roughly 25 years. Sales volumes across the Lower Mainland are sitting near historic lows. And for many of us, that word collapse no longer feels dramatic. It feels personal. According to the latest verified data from Statistics Canada and regional real estate boards, home sales in Greater Vancouver have fallen sharply compared to the pandemic boom years. We all remember 2020 and 2021, when bidding wars felt endless and prices were climbing by the week. Now, we're staring at a market where listings are piling up and buyers are stepping back. Inventory has risen, transactions have slowed, and confidence has taken a serious hit. We can't look at this without talking about interest rates. The Bank of Canada's policy rate is currently sitting at 2.25%. That's lower than the peak we saw during the tightening cycle, but it's still a world away from the ultra-cheap money era that inflated prices across Metro Vancouver. Even at 2.25%, borrowing costs remain much higher than what many of us budgeted for when we bought at the top. At the same time, headline inflation eased to 2.3% in January and February 2026. On paper, that sounds like progress. Inflation is close to target. But for families across British Columbia, the damage has already been done. Our grocery bills, our insurance, our property taxes, those didn't magically rewind. We're still feeling squeezed. We also need to remember what changed in our tax landscape. The federal government canceled the consumer carbon tax in April 2025, which many of us welcomed at the pumps. But the industrial carbon tax is set to hit $110 per ton in 2026. That cost doesn't disappear. It flows through supply chains. It affects construction materials, transportation, and energy-intensive industries. And in a housing market already under pressure, every added cost matters. So what does this 25-year low really mean? It means sales activity has dropped to levels comparable to the early 2000s. Back then, Vancouver was a very different city. Our population was smaller. Our average home prices were a fraction of today's values. Now, we're talking about benchmark prices that are still high by national standards, but with far fewer buyers willing or able to step in. We are watching a standoff. Sellers are anchored to yesterday's peak prices. Buyers are cautious, worried about job security and future rate moves. And investors, who once drove significant demand in the Lower Mainland, are far less aggressive than they were during the boom. For Canadian residents and taxpayers, this isn't just about numbers on a chart. It's about retirement plans, equity lines of credit, and whether our kids will ever afford a home in this city. And as we dig deeper tonight, we're going to examine whether this is a temporary freeze or the beginning of something much bigger. When we talk about chaos, we're not just using that word for clicks. We're describing a market that has lost its rhythm. In the Greater Vancouver area, sales to new listings ratios have fallen into territory that signals clear buyers' market conditions. That means we, as sellers, are competing against each other. It means price reductions are becoming more common, and it means the psychology that once drove panic buying has flipped into hesitation. Statistics Canada's housing data confirms that residential investment has cooled significantly compared to the peak years. Construction activity is still ongoing, especially in condo-heavy pockets of the Lower Mainland, but pre-sales are slower. Developers are offering incentives that would have been unthinkable 3 years ago: closing cost credits, design upgrades, even price adjustments. When builders start sweetening the deal, we know demand has weakened. Now, let's widen the lens. This isn't happening in isolation. Across the country, we're seeing stress points. In the GTA, mortgage arrears have quadrupled from post-pandemic lows. That's not speculation. That's confirmed through banking and credit data. While arrears remain low by historical crisis standards, the rate of increase tells us something important. Households that stretched during the low-rate era are now feeling the full weight of higher payments. And here in British Columbia, we're not immune. Many homeowners in Vancouver locked into variable rate mortgages when rates were near rock bottom. As the Bank of Canada raised rates over the past cycle, payments climbed sharply. Even though the policy rate now stands at 2.25%, the reset shock is real. Fixed-rate borrowers renewing in 2026 are discovering that their new payments are hundreds, sometimes thousands of dollars more per month than what they signed up for 5 years ago. We also have to factor in our broader economic picture. Headline inflation may have eased to 2.3%, but wage growth has not outpaced housing costs over the long run. Our incomes have not kept up with the extraordinary price surge that defined Vancouver real estate for over a decade. That mismatch is now being exposed. At the same time, investor sentiment has cooled. Higher carrying costs, new regulations, and shifting tax policies have changed the math. The cancellation of the consumer carbon tax in April 2025 offered some relief to households, yes. But the industrial carbon tax, climbing to $110 per ton in 2026, continues to raise input costs for businesses. That filters into construction, renovations, and operating expenses. When costs rise and demand falls, margins get squeezed. We also need to talk about immigration and population growth, which have supported housing demand nationally. Canada continues to welcome newcomers, and that adds long-term housing needs. But short-term affordability constraints can override population growth. If financing is tight and prices remain elevated, transactions slow down even if the underlying demand exists. So here we are. Listings are up, sales are down. Price growth has stalled or reversed in certain segments. Detached homes in some parts of Metro Vancouver are seeing noticeable price cuts. Condo sellers are facing longer days on market, and buyers are waiting, watching, calculating. This isn't the frenzy we lived through in 2021. This is a recalibration. The question we must ask ourselves is whether this is a healthy correction or the start of a deeper slide that could reshape our housing landscape for years to come. Let's be clear about something. A slowdown in sales does not automatically mean a crash in prices, but when activity drops to levels we haven't seen in a quarter century, pressure builds. And we are starting to see that pressure translate into softer benchmark prices in several segments across Metro Vancouver. According to Regional Real Estate Board data, benchmark prices have edged down from their pandemic peaks. Detached homes, which once felt untouchable in neighborhoods from Richmond to North Vancouver, are no longer immune to negotiation. Condominiums in parts of Surrey and Burnaby are sitting longer on the market. Sellers who once dictated terms are now adjusting expectations. At the same time, we have to acknowledge that Vancouver remains one of the most expensive housing markets in Canada. Even after recent declines, average prices are still far above the national average reported by Statistics Canada. So when we say collapse to a 25-year low, we are talking about transaction volume, not a return to early 2000s pricing. That distinction matters for us as taxpayers and homeowners. The bigger concern is household balance sheets. Across Canada, debt-to-income ratios remain elevated. Many families stretch to enter the market when interest rates were near zero. As mortgages renew at higher rates, monthly payments climb. In Toronto, mortgage arrears have quadrupled from post-pandemic lows. While the absolute numbers are still manageable compared to past crises, the trend line tells us that financial stress is increasing. Here in British Columbia, we're watching similar warning signs. If unemployment rises or economic growth slows, those pressures could intensify. The Bank of Canada's policy rate at 2.25% reflects easing inflation, now at 2.3%. But the central bank has been clear that it will move cautiously. We cannot assume a rapid return to ultra-low borrowing costs. Those days may not come back anytime soon. We also have to consider government policy. The federal government has focused on increasing housing supply, streamlining approvals, and working with provinces and municipalities to accelerate construction. But supply takes time. Permits, labor, MA. The cancellation of the consumer carbon tax in April 2025 reduced some direct household costs, but broader economic pressures remain. The industrial carbon tax at $110 per ton in 2026 continues to shape energy and construction expenses. Developers factor these costs into new projects, and when margins tighten, some projects get delayed or canceled. That can reduce future supply, even as current demand cools. So where does this leave us? We are standing in a market defined by uncertainty. Buyers are cautious, sellers are adjusting, lenders are more conservative, and policymakers are walking a tightrope between supporting affordability and maintaining financial stability. For many of us, this is not theoretical. It's about whether we refinance now or wait. It's about whether we list our property or hold off. It's about whether our adult children can stay in the Lower Mainland or are forced to look elsewhere in Canada. The reality is that Vancouver's housing market is undergoing a serious reset. The next question is whether that reset becomes a controlled landing or something much more painful for our communities. As we look ahead, we have to ask ourselves what a controlled landing would actually look like for Vancouver and for our country. A healthy correction would mean prices gradually aligning more closely with incomes, sales stabilizing at sustainable levels, and families regaining some confidence. It would mean we avoid a sharp spike in defaults, avoid forced selling, and avoid the kind of panic that can turn a slowdown into a full-blown crisis. Right now, the fundamentals are mixed. Inflation has eased to 2.3%, which gives the Bank of Canada some breathing room. The policy rate at 2.25% is no longer in emergency tightening territory. That provides some predictability for borrowers. But predictability does not erase the payment shock many households are facing as they renew mortgages taken out during the ultra-low-rate era. We also have to remember that our housing market does not operate in isolation. It connects to our banking system, our pension funds, and our municipal tax bases. When sales volumes drop to 25-year lows, real estate-related revenues decline. Fewer transactions mean less land transfer tax, fewer development fees, and slower construction activity. That affects jobs across trades, finance, legal services, and retail sectors tied to housing. For Canadian residents and taxpayers, the stakes are high. Many of us have the majority of our net worth tied up in our homes. If prices soften further, paper wealth shrinks. That can dampen consumer spending and slow the broader economy. On the other hand, if affordability improves, younger Canadians may finally see a path into the market. That's the trade-off we are living with. We should also be honest about expectations. Vancouver has experienced cycles before. We saw downturns in the early 1980s, the 1990s, and after the global financial crisis. Each time, the market eventually found a floor. Population growth, limited land supply between the mountains and the ocean, and strong long-term demand have historically supported prices. But past performance does not guarantee future outcomes. Our debt levels today are higher. Our global economy is more interconnected. Our policy landscape has changed. The cancellation of the consumer carbon tax in April 2025 may have eased some household pressure, but the industrial carbon tax at $110 per ton in 2026 continues to influence business costs. We cannot ignore how these broader economic policies feed into housing affordability, construction viability, and long-term supply. So where do we stand tonight? We are in a moment of adjustment. Sales are at levels we have not seen in roughly 25 years. Buyers are cautious. Sellers are recalibrating. Policymakers are watching closely. And we, as Canadian taxpayers, are feeling the uncertainty in real time. This is not just a story about numbers on a spreadsheet. It is about our retirement plans, our children's futures, and the stability of our communities across the Lower Mainland and beyond. We all have a stake in how this unfolds. I want to hear from you in the comments. How is this affecting your family? And if you value clear, fact-based reporting that speaks directly to what we are living through, make sure you subscribe to CA Reporter so we can continue following this story together.